Tom is the 8th president and chief executive officer of the Federal Reserve Bank of Richmond, where he has been for 6 years. In that role, his responsibility is the bank's monetary policy, bank supervision and regulation, and payment services, as well as oversight of the Federal Reserve System's Information Technology Organization. So in addition, he serves on the Federal Reserve's Chief Monetary Policy Body, the FOMC. Tom hails from Tampa, Florida, originally. He has more degrees than I understand from Harvard, but he does have 3 degrees from Harvard. But I think one of all of our secret weapons with Tom is that Tom has 30 years experience in the business world prior to coming to the Fed. He served at McKinsey, where he oversaw the southeast part of the country, but he was also the CFO, and I think the chief risk officer prior to joining the Fed. Additionally, he has background in the Fed before joining, where he served on the Atlanta Fed board from 2009 to 2014 and chaired that board from 13 to 14. So Tom, thank you. Thank you for joining us here today. And I think it is interesting. I guess we just had an FOMC meeting, January 30th to the 31st. Did you vote?
I did.
I did, vote.
Yeah. It would have been a little awkward to not have exercised the right.
Can you give us a little bit of inside? How does that work? Who votes? How does the voting work? Tell us a little bit about that.
Okay, so there are 19 members of the FOMC, and for some arcane reasons that are built into the statute, 12 of the members vote at every meeting. So the 7 governors all vote, and then the presidents vote in a rotating order. I'll say I really don't think it matters. We haven't had a 1-vote margin in at least 40 years. It's a consensus-oriented organization. And maybe most importantly, during the times I've voted and the times I haven't voted, I've felt equal ability to try to have influence on what's happening in policy. So we go to the meeting. There's often presentations by the staff. There'll be a go-round on economic conditions. There'll be a briefing on discussion on policy. There'll be a go-round on policy in the memo. And then when it's all over, there's a secretary who'll call the roll and vote. And so, Jay will vote, then they go in alphabetical order after that. So as a Barkin, I feel that my vote counts at least somewhat more than others.
How many of the people who are voting have a deep business background like yours?
Well, it's a mix of people with a mix of skills. I'd have to think about it. Almost all of the members of the committee have backgrounds in policy or in economics. There's a zillion PhD economists. I think Jeff Schmid, who's in Kansas City, who's a banker, and then my background, I think that's about it.
So do you think it distinguishes you in the room?
Oh, that's what I tell people outside. But no, I think there's value to diversity, and I think there's value to having a different perspective in the room. I'm a competitive person, and so when I joined the committee, I tried to ask myself, what am I going to say that's going to be useful, different? And I do think I had the opportunity to work with companies as they decided whether to hire people or fire people, to raise price or occasionally to lower price, to invest in capital expenditures or other big investments for the future or not. And so I think as we're testing the economy and trying to ask questions of what's actually happening, I would like to think I've got something to add there. I also think having been at McKinsey, where there's lots of very smart people building models and you're always trying to test them, I also try to bring some amount of critical thinking to the question of the models that we're looking at, how valid are they or not. You get into interesting questions. For example, rate increases famously work, as Milton Friedman said, with long and variable lags. But if you ask people how long the lags are, they're actually pretty long and pretty variable. And so the confidence interval on a lot of these things is so wide as to ask the question how you're making policy against them. And I'd like to try to do some of that stuff, bring some business judgment, if you will, to some of these academic questions.
One of the things I've noticed, we have a national platform. I feel like I'm on the road a good bit, traveling. I don't think I hold a candle to your schedule. One of the things that Tom is really well known for is the work that he does at least 2 or 3 weeks a year out on the road, going and talking directly to businesses. Talk a little bit about how you gather and why. Why do you do that?
2 or 3 weeks a month, not a year. Yeah.
Yeah, a month, sorry.
Well, so I mean, I was in Western Carolina. So my district is South and North Carolina, Virginia, DC, Maryland, and almost all of West Virginia. And I try every week to be out. So I was Monday, Tuesday, I was in Asheville, Monday, booming city. I was in Western Carolina Tuesday. Actually, the Cherokee Indians have a casino there and a whole operation, and trying to understand a part of Appalachia that's also in my district. And when I'm there, I will always try to find whatever the most important businesses are there and try to understand how they're seeing the economy, whether it's, like I said, how they're doing pricing, what their demand looks like. I'm trying to get real-time signals there. I'm trying to understand what's happening in the towns. Like I said, Asheville's a lot different than Western Carolina. DC's a lot different than South Carolina, and trying to understand my district as best as I possibly can. And then almost always there are issues going on that I can learn from, whether that be childcare or housing or any of those sorts of things that are happening. A couple interesting things I saw in Haywood County, North Carolina yesterday. A paper plant closed, 1,100 people laid off in a county of 17,000 people. 1 year later, the unemployment rate in Haywood County was actually down at 2.9%. So how could that be? And I think it just speaks to this issue we're having with the labor market, not issue, the positive of the labor market, which is how does unemployment stay so low? And the answer is there's a lot of people still looking for workers. And in Haywood County, there were a lot of people still looking for manufacturing workers, many more open positions than the number of people laid off. And so people got repotted. There's this question of reprioritization of spend. When does the consumer spending surge slow down? I was talking to the casino. The casino's got every bit as many visitors as they had a year or two ago, but the average spend is down almost half. What's going on there? I think it's people aren't at the $25 table, they're at the $10 table. For anyone listening, I don't really do a lot of gambling, but I'm assuming that's what the tables are. And when you're looking at reprioritization of spend, you start saying, okay, now I get it. People have only this much money. They're spending more here. They're spending less there. I think you understand the economy much more fully if you're on the ground in Haywood County than if you're not.
It is, sorry, 2 to 3 weeks a month. It's remarkable how much information you collect. Talk a little bit also about the board of Richmond. You also have an advisory board in Baltimore. You have an advisory board in Charlotte. We get together 8 times a year to give you really a roundtable. Discuss sort of the motive behind that and how you think about your board.
Yeah, so first of all, thank you for your service, and Barbara for yours, and Alice is here, and Cecilia I saw, and I probably missed somebody that I apologize for if I did. You guys are nice enough to give your time to us, and what we do is 8 times a year, we basically tap your brains on what's happening in the economy, and I try to construct boards that have a diverse view of what's happening in the economy. During COVID, we had the CEO of a healthcare system on our board, and he was very useful for understanding, what was happening in terms of whether it was vaccine rollouts or, shutdowns in the economy. Jody's got a dual hat because she's in real estate, which is very useful, but also retail real estate. And so understanding what's happening in the consumer side, which is 70% of the economy. Barbara brings a lot on the industrial side. So we're getting, I think, a broad-based view of what happens in the economy. And if you will, every 6 weeks, I get to both tap their thinking on what's happening in the economy and test my thinking about what I'm saying. And quite frequently, and I was on the Atlanta board, as Jody said at the beginning, so I had this experience. Quite frequently, I walk out with my views deepened, shapened, or changed. And I really like the opportunity to test my synthesis from 6 weeks out in the market every 6 weeks with a bunch of people who, have a broad-based view.
All right, so inflation data, it's looking very good. As somebody who's in commercial real estate, I'm highly interested in when we're going to get about this. And landing the plane, where are we in landing the plane?
Well, the airport's right there, but we're still up in the air. And so there's some room between where we are and the runway. And you definitely want to land on the right runway and not the wrong runway. More seriously, I just say the the data that has been coming in over the last couple of months has been remarkable. Just to give you a feel for some of it, GDP came in the fourth quarter at 3.3% growth. Normal would probably be 2 or a little bit under. GDP year over year, fourth quarter to fourth quarter, 3.1% growth. So demand still very healthy. Now, unemployment, 3.7%. We added 353,000 jobs last month. This is still a tight labor market. And I should say we haven't had 2 years of under 4% unemployment in over 50 years. And so a very strong labor market. And inflation, which at the beginning of last year was still quite elevated, the last 7 months have actually been basically right at our target. So the 12-month numbers are 2.6%, core would be 2.9%, but the last 7 months, 1.9%. So, inflation down while demand is still healthy. That's why the drumbeat you hear is the soft landing drumbeat. I'd say the challenges on inflation, it's not that broad. It's really been disinflation in goods. A lot of goods prices increased with all the supply chain issues. Some of them have started coming back down. Apparel would be a good example. Used cars would be another good example. And services and rent inflation have both stayed more elevated. And so inflation overall is down. The mix of it is not as broad-based as you might hope. And so we'll just have to see whether it's going to stay sustainably down, which would be terrific, or if there's still more inflationary pressure to come.
What could drive that inflationary pressure?
So you want me to go dark here?
Yeah.
I know no one wants to hear that. Well, I mean, wage growth is strong, and that's not a negative, especially if you're a worker. But to the extent that productivity doesn't come along, that runs the risk of creating increases on the services side, especially. Housing is still tight, and so while there are a lot of people forecasting that rents will come down, it's also the case that houses are still selling very quickly, and prices and rents are still increasing. And there is this question in my mind about whether the drop we've seen in goods prices is sustainable, or whether this is just a rollover from COVID. In the end, we're going to have a different lens. So you could well have pressure on prices. I'll even say more broadly, we had 20 years before COVID where businesses knew they had no pricing power and consumers knew that prices never went up. And so if businesses thought about raising prices, consumers would switch to private label or something else, or intermediaries, retailers would say, don't bring that price increase into my shop. I think you've had 2 years of significant price increases. And so I do think businesses feel they have a little more pricing power than they used to, or at least prices on the list of levers to use in a way that wasn't before. And so I do have this question, and for the economists, you could put it in the realm of inflationary expectations, whether the expectations of businesses and consumers, which had converged so neatly into a very narrow range, haven't just widened a bit, and whether that wouldn't create more ability and confidence in price setters to increase prices and for price receivers like you and me to actually accept it. So that's not a prediction or a forecast. I'm not saying that's going to happen, but that's the risk. And that's one of the risks I think I'm trying to navigate against.
So do you have a sense about this consumer? Because the consumer has held up remarkably well. They really have. They don't seem to have fear for their jobs. But do you see them continuing to grow in strength, or do you think they're going to slow down a little bit?
Well, so there's this, so the story a year ago was that the combination of stimulus and suppressed spending during COVID meant that consumers had all this excess savings in their pocket, and that excess savings was getting spent down month after month after month, and eventually they would run out, and then spending would slow. That was the story a year and a half ago. And I think if you look at what's happened, it is the case that when you talk to people who sell to lower income consumers and even middle income consumers, that those consumers seem to have hit some limit. They're reprioritizing, they're stretching. People who sell to higher income consumers don't tell me that at all. I mean, they're still, you and I are still spending like drunken sailors. But I think now when you reflect on what's happened in the last year, you have to ask a different set of questions. And I think about it like this. For the last year and a half, unemployment very low, 3.7%. Wages are up, and wages are up faster than inflation over the last year and a half, not the 2 years before that. And so people have more spending power. At the same time, the equity markets have been very strong, home values have been very high, and so people with assets have more wealth. And so the combination of those two seems to have encouraged people to spend more freely than they otherwise would, and the indicator for that is the savings rate. The savings rate, which is the percent of your income that you save, before the Great Recession was sort of in the 4 to 5% range. After the Great Recession, it went up to the 7 to 8% range. And so people were saving a lot more. Maybe home values were down. People were saving for retirement regardless. For the last 2 years, it's been back in the 4% range. So people are spending more out of their earnings than they were or than they did over the prior 10 years. And I think that's because they've got jobs, wages are up, they've got more wealth, and so they've got more confidence. And maybe there's even a, post-COVID, what was I saving it for kind of emotion going on there. And as long as that continues, I think you see a healthy consumer spending environment. Recessions, I don't want to use the R word, but there's a lot of talk about how they come, rates and all that stuff. Most of them come suddenly, and something happens, think the pandemic, think Lehman Brothers, think 9/11, that causes consumers and businesses to pull back strongly in unison. That's really the most likely scenario for when things go south. And you can't really forecast that. So my forecast doesn't have that happening, but that's the thing you always worry about, is something that causes people to pull back. And that would be the risk on the spending side.
External shocks.
A confidence shock of some sort, which could come from external or any other source.
So are you telling us that the 2.6 or the 2.9 is not enough to say we're done? We just call it a day?
Declaring victory is very enticing, but you're never going to hear me do that. I think our target's 2%, and we'd like to get inflation down to 2%. It's not difficult to stay focused on that when you've got an employment market that continues to be as strong as it is. And I said something about that earlier. I mean, we have an unemployment, we have a labor market that is at historic levels of strength. Job gains, unemployment, job openings, initial jobless claims. All these metrics are very strong, and inflation's coming down. And so I'm very supportive of being patient, to get to where we need to get. I see at this point the trade-off, which is, coming into better balance, is still being in favor of continuing to work on inflation.
So are you aware of $2 trillion of commercial real estate loans coming due? About $660 billion that will mature in 2024 alone. I think about 20%, maybe just under 20% of that is in office. Does that raise concern for you in that coming? And how does the Federal Reserve think about that?
I'll talk about how I think about it, which is commercial real estate's a big sector, probably better. Retail, your sector is doing well, and industrial data centers.
Still take lower rates.
You still like that. The hotels, there's lots of parts of real estate. They're really talking about office, commercial office, and really inner city, downtown commercial office, maybe even B and C quality. And that is a troubled sector. It's troubled in part by rates, but it's troubled in large part by work from home. And in DC in particular, you guys know, it's a particularly difficult market. So it wouldn't surprise me to have, real issues in the commercial real estate office segment coming, and some have already hit, and I'm sure there'll be more to hit. Where you worry the most about it, I don't want to be cavalier about it, it's less the individual investors in those entities and more the banks and other financial institutions that stand behind them. And the challenge is whether those losses come back to the banks, and whether they're banks with exposures significant enough to then, cause them to have contagion into other parts of the financial system. That's really the risk. That's not a new risk. We've had real estate issues before, 08, 74, 75, 91. And my hope and trust is that the banks are well aware of those segments and have stressed it. That doesn't mean you're never going to have a bank that's going to get wrong-footed on commercial real estate, but that the sector as a whole has taken the precautions. One of the interesting things about the risks that we face today is that 2 years ago, if I had been here, or last year when I did, do a video with this group, the world was absolutely convinced we were going to have a recession, absolutely convinced. And so when you're absolutely convinced you're going to have a recession, what do? You cut back on hiring. You maybe slim down your overhead or your capital expenditures. If you're a bank, you tighten your credit. And so I think we're all a lot less over our skis than we were on all these recessions that happened with a sudden jerk from left field. And so my hope and expectation is a lot of this tightening and care and write-offs and management has already gotten out in front of some of the issues that are undoubtedly in front of us.
Undoubtedly, because I think there's also this conversion of tightening up of reserves. And the more and more capital reserves, it feels like there's less liquidity for the commercial real estate that's coming through. Can we talk a little bit about housing? Housing affordability is a growing concern. Have you seen any promising housing solutions during your travel in the 5th District?
Well, it's pretty interesting, and I gave a speech on this in Virginia in November. So first of all, housing's been underbuilt for a generation. Demand has escalated as you work from home. The one thing you realize is that you don't like your home very much, and so you need a better home or a bigger home. So you have a lot of demand and not enough supply. The solution has got to be about supply. Subsidizing more demand is only going to create bigger problems in terms of pricing. So you got to create more supply. And it's been very interesting as I've traveled because, and the Post had a really good article on this a month or two ago. There are a bunch of cities in my district, Raleigh would be a good example, where you can really build, if not 360, 320 around Raleigh. And if you go to the exurbs around Raleigh, you will see the national home builders there in force. And there's house after house after house, subdivision after subdivision going up. And the prices are $250,000 to $300,000 a house. So they would fit the category of sort of affordable for a middle income worker. They're an hour outside of Raleigh. And so the commute 5 years ago would have been a problem. But if you're only in the office 2 days a week or 3 days a week, maybe that commute's not that bad. There's a lot of, they've figured out how to attract developers there through whatever combination of permitting or land availability. But I think this notion of buildable land in a 360 around a city is huge. It's not, Charleston well. Charleston's not even 180, and it's not that affordable. So that's a different set of issues. But if you go into the surrounding Raleigh, surround Charlotte, surround Greenville, all of those places, that's where the national home builders are, and they're building in force. That's not the case here. And you could argue how much of that is land availability, land price, demand, but it's a lot harder to do it, NIMBYism. It's a lot harder to do it here. But in other parts of my district, they're really building housing at remarkable scale. We
are seeing that throughout South Carolina, that's for sure. Economic conditions, you touched on this earlier, but quickly, they can change really quickly. How do you update your understanding of the economy when you don't have real-time data?
Well, one of the things we all got better at during COVID was real-time data. So one of the things I look at, for example, is credit card spending every week and what it looks like. And for those who are looking for advance, there was a lot of bad weather in January, so it doesn't look nearly as good in January as it looked in December or November. We'll see how that plays out. But for me, I get it on the streets. And so, I described my day in Haywood County yesterday, but that's what I'm trying to do, is to do roundtables with businesses across sectors and try to understand what they're seeing in terms of real-time demand, how they're feeling about their prospects for hiring or whether they're preparing for layoffs, and how they think about pricing today versus yesterday versus tomorrow. And I think that gives a ton of insight, which you have to be careful about. You can't, just because one business is good and one business is bad, it might be the business, not the sector. So you need enough data points that you can kind of aggregate. You need to control for what sector you're in and what competitive situation people are in. But again, I feel I can do that and test those insights then more and more as I travel around the district. That's where I think I'm getting my best information.
All right, one more question and then we'll open it up to the floor. So if I've sat here and I've listened to you, it seems like the economy generally seems to be in a good spot. Inflation is slowing. The labor market, though, seems very solid. Are you concerned? And if we listen to 60 Minutes, if we listen to Jay Powell, it sounds like there will be some inevitable lowering at the end of the year. I don't know if that's right or not. Are you concerned right now that this could just be a head fake and there's really more inflation? Or do you really feel like you can see the airport, as you said earlier, and we're going to land this plane this year?
Oh, I said we could see the airport. I didn't say anything about where the plane was going. There were 4 or 5 tries in that question to get me to say something. So first of all, and I want to say this clearly, if you had given me a year ago or 18 months ago, 3.7% unemployment, 2.6% inflation, and a 3.3% GDP growth rate, I would have taken it and gone on vacation. So that's clear. You should feel good about where the numbers are in the economy and where it sits. That is a good thing. I think there's still a reasonable amount of uncertainty in what we're seeing. I talked about inflation. Is this goods that will be temporary? That would be your head fake example. Goods are kind of going to be a head fake, and then we're going to be stuck with this elevated rent and services inflation. That's one level. Or, have expectations in the Fed's actions and supply chains opening up and labor force increasing, all done its work and brought inflation back to where we were before COVID. That's one big uncertainty. And I'm waiting to get more clarity on that before declaring anything more in terms of what we do on the policy side. I'd say there's also demand uncertainty too. You've got rates should have had more impact in theory than they've had. Maybe it's just being delayed, and we'll see more of it like you described on the commercial real estate side. Banks have cut back. Maybe that'll have more impact. On the other hand, the long rate is down almost 100 basis points from November, and consumer sentiment is up, so maybe we'll have more demand. That's another uncertainty. On the labor market, I don't think I didn't expect 353,000 jobs, and I don't know anyone who did. And so is that real? And all of a sudden people are hiring again? Or is it more what I'm hearing, which is that people aren't hiring as many, but they're also not firing either because they're worried about how they're going to replace this? Those are 3 pretty big questions about what's happening in the economy. And that's, why I make the case for not being in any particular hurry. Let's see what we learn and, make policy appropriately.
All right, are there questions?
Thank you, Gary Shapiro, Consumer Technology Association, and thank you. You sound so data-driven to me, and I love that, but you're also out in the field, and I appreciate that. I'm just curious, since you rely so much on these numbers, and that's all you've been talking about, if there was a number that you really trust totally and you think it reflects reality, which one would it be? And which number would you like to have that you don't have that you would like to be better? For example, the unemployment rate, relying on people still looking for a job for a year, or the cashless economy, which seems to be growing, or what number would you like to see improved?
So these numbers are, they do get revised. And it is also a fact that a lot of the survey response rates for these numbers have gone down. And so, you get wary of, declaring too much love for any particular number or any particular read. And you've heard me on the, for example, I've mentioned this 353,000 jobs last month. I'm going to give you some numbers that are in the zone of right, but not perfect. It's January. In a typical January, people cut jobs because you've added retail jobs for Christmas. So the normal January would be a loss of 2.6 million jobs. This January, we lost, I'll make up a number, 2.5 million jobs. Seasonally adjusted, it added up of an increase to 353,000. Now, how confident do you feel about that number? Right? Not very. So I think in the end, you sort of take everything as it is. It's the best metric we've got, but it's not perfect. On a regular basis, as I said, I do look at weekly credit card spending because those are real numbers. I know what to do with them. I have to adjust them, but I kind of know what to do with them. And I look at initial unemployment claims because by and large, when people get fired, they file for unemployment. So that tells you something about the job market. But a lot of these other things, I think, I'm not negative on them. I started thinking all these numbers were worthless, like inflation, that number can't be right. Yeah, they're pretty good. I think the people who did them did as thoughtful a job as you could possibly do, recognizing that nothing's perfect.
I hear you talk about the trim mean, though.
Mm-hmm.
You might want to talk just a little bit about that. That's interesting.
So on inflation, I gave you a couple numbers early. One was that 12-month inflation, 2.6%. The second was that 12-month core inflation was 2.9%. That's excluding, food and energy. By the way, people actually consume food and energy, but should matter. The thing I've worried about is the breadth of inflation coming down. If oil prices go up and then oil prices go down, that'll make the headline number look good, but you could have a bunch of other things that don't look as good. And so the Dallas Fed tracks something called the trim mean. And to oversimplify what they do is they cut out the 25% of the items in the basket that have the biggest price increase. They cut out the 25 that have the lowest price increase or price decrease, and they leave you with the 50% in the middle. And that's probably more reflective of where reality is. That for the last 12 months is 3.3%. Doesn't mean it's terrible, but it's come down, but it hasn't come down as much as some of these other measures because oil prices have come down a lot, used cars have come down a lot, and those are outweighing the other numbers in the metric.
Tom, Roberta List with Cushman & Wakefield.
Great to see you again.
Thank you for all the comments. Jody, great job. So Tom, 2 questions. First, when you were at Harvard, did they have some kind of sale where if you buy 2 degrees, you get a third one free or anything? Is that
I don't remember that
okay.
at all. I will say in the 70s, the degrees were a lot cheaper than they are today.
For us all. My question's about AI. With all of the data, I agree that you just do a phenomenal job speaking to all the businesses and understanding what's happening on the ground, and then marrying that with the tremendous amount of data. How does the Federal Reserve use AI for any predictive measures or legislations or acts that we might be making?
Well, it's a place we're investing. And there's sort of and there's AI, and there's on your way to AI. So, but the simplest way to describe it is, first of all, we have an awesome forecasting model that tries to forecast the economy. And it is a model of historic proportions that tries to actually model out the entire economy and bring out a forecast. It's called FRBIS, for Federal Reserve Bank US, I guess. And that's an example of bringing modeling and technology to the question of forecasting the economy. And we've got lots of models like that try to forecast the economy. So in macroeconomic policy, we've got forecasting models. In bank oversight, which is another thing we do, we actually have models that try to identify those banks with the biggest risks. And so you've got people building models and trying to leverage artificial intelligence to say, how do we go through all the data that exists and that we have to sort of find the places where we need to be upping our supervision and places where, we can tailor appropriately because the risk is lower. Both of those are at least intelligence, and whether they're artificial intelligence will have to get better. We're still on early days with a generative AI, in part because, the tools that are used to create it actually take note of where the information is coming from. So, for example, if the Fed started saying we need to do a lot of stuff on, when do you lower interest rates, that would somehow show up in the artificial intelligence. That'd be information that you wouldn't want to get. So we're still trying to figure out the security side of that. So we've got some controlled experimentation, but the generative stuff I think is still on the come.
Oh, right here.
Hey, Ann Kress, President, Northern Virginia Community College. So I want you to talk a little bit about the actual availability of workforce, right? Because the unemployment rate isn't necessarily a marker of that, because there are a lot of folks, and multiple feds have done a lot of great research on people who effectively have taken themselves out of the labor market. And the US Chamber refers to this region as having a severe labor shortage, which is going to compromise its some ability to grow. And that's not just affecting here, but can you talk a little bit about the challenges that are really facing the labor market?
Mm-hmm. A couple of metrics. I've talked about unemployment rate. which is very low. And that a simple way to think about that is, people looking for a job, what percentage of them can get a job? Okay. A broader measure that I kind of like is employment to population, which is for relevant sectors, say prime age people, what percent are actually working versus not working. And just to give you the national economy, employment to population is a little over 60%. And so there's a lot of people not working. Now, I'm not saying that's a bad thing. I mean, some are in schools, some are taking care of parents or kids, some are happily retired. But there's a lot of folks in that mix who aren't in the workforce. And if we want to grow our workforce, that's a very interesting thing to think about. In my district, what you see is that DC, West Virginia, DC, Virginia, and Maryland have actually very high participation rates on a national scale. South Carolina and West Virginia have very low participation rates on a national scale. And some of that is demographics, to the extent you've got an older population, that would be part of it. But there's a lot more to it than demographics. There's a piece which is education, preparedness, opioids, show up in there sometimes. But I think for us as a country, we got to live in the 90s through a period where we were long workforce. That was the baby boom getting its prime years. That was women more fully participating. That was people being healthier and living longer and working longer. That was even access to offshore labor. And I think we sort of assumed that would last forever. And a bunch of businesses did things like stop training programs because you could find enough trained people on the street. And I think what COVID has exposed, as participation of 60 and up has dropped significantly, and I guess with the questions on immigration, is we may well be at the verge of a decade or two where labor isn't long, labor is short. And so questions like how do you get people off the sidelines become a pretty big deal. So we're not the first country to have this problem. Japan's very interesting. I don't aspire to be Japan, but Japan's very interesting. Their labor force participation of people 60 and up is 17 percentage points higher than ours. Ours is like 36, theirs is like 53. That's a crazy, interesting difference. Now, older people in Japan are healthier, but there are also incentives to work. They've worked hard on job design. But if you don't have enough workers, you're going to work on how do you get more advantage of workers. Canada is another interesting one. Women's labor force participation in the US and Canada's labor force participation of women were both the highest in the world in the year 2000. And since 2000, ours is basically flatlined and theirs has increased another 5 percentage points. And there's lots of theories of the answers. One that intrigues me is Canada taxes second incomes just like they tax first incomes. So in other words, the first X is non-taxed in the US. In the US, if you have a second earner, the first dollar is taxed. In Canada, it's not taxed that way. So that's interesting. So are there tax policy and other policy changes you can come up with? Childcare, someone will bring up, absolutely. That could be relevant to how one gets higher participation. And those are just big segments. I haven't talked about in South Carolina and West Virginia, for example, the people who are, undereducated and feeling hopeless and not, participating in the economy and what one can do to get theirs. And you didn't ask me for this, Ann, but I believe community colleges might be part of the answer. But I think this may well be the business problem that we have for the next decade or two. I don't think it's an unsolvable problem or an unaddressable problem, but it is a very important one for us to get working on.
Hey, Tom, Caleb with Forvis, we're a public accounting firm. And first of all, thanks for coming here. I've heard you speak several times, and I really appreciate how you're able to take very complex ideas and distill them down to understandable levels.
That's usually what someone says before they ask a really complicated question.
So as much as I want to ask you about your Mountain Dew, I'll save that for another time. But my question is around how does the national debt, the consideration of our debt obligations, rising interest rates, some feel like it's unsustainable, how does that impact the discussions around the Fed and your outlook, or is it just too nebulous to really affect your decision-making today?
Our decision-making is very focused on our mandate, which is unemployment and inflation. And if I could massively oversimplify a complicated discussion, is inflation at our target or headed toward our target? Is, where are we on against the maximum employment part of our mandate? There's a lot of other stuff out there, how much money is being spent fiscally, what are the risks in Taiwan, that are all important to understand as part of the context, but they're not actually our mandate. Our mandate is inflation and unemployment. We're very focused on that, and you have to take, I'll call it these tailwinds or headwinds, you just have to take them as environmental and make policy against them, as opposed to sort of say, one of the mistakes of the 60s famously was William Chesney Martin saying, we're not going to do a rate increase if you'll do a tax increase, to Lyndon Johnson. Well, that never ends well. And that's not the business we're in. We're in the business of the environment's the environment we're in. Let's see what we can do about it. Inflation in a way with the least damage to unemployment.
Hi, Tom. Chris Brew with Donahoe. First thing I want to do is thank you for your leadership. During the darkest days of COVID, we had many conversations. One of our business lines is hotels, and we were in a crisis situation in the hotel industry. And having a regional board president contacting ground level troops to find out what's really going on in real time gave us a lot of confidence that there was interest and people were listening. So really appreciate that. I don't think all board presidents get to that level. My question pertains to the 2% target. So the 2% target, I think, has been around 40 years or more. And we're in a very different world today than we were 40 years ago. Just think about technology, think about AI, all the advancements we have in technology, the global economy, the debt to GDP ratio. Everything is so incredibly different than it was when whoever it was on the Fed said 2% is the magical sacrosanct number. Is it? What's wrong with 2.5? And is there a time the Fed needs to revisit this target? Because it's a very different world today than it was then.
For a second, I thought you were sending me to a lower target, when you started talking about productivity and artificial intelligence. So just historically, there was a huge debate in the 90s about what the target ought to be. Interestingly, the debate was between 2 or something lower. Greenspan famously said, stable prices mean 0. And there were other people arguing for, 1.5 to 2. Every central bank in the world is basically at 2. Some are at up to 2, some are at 1.5 to 2.5, but they're all basically at 2. And I want to say 2 is not some magical, mythical creature that no one's ever seen. We've been at it for, I'll make up numbers, 28 of the last 30 years, right? And by the way, we're pretty close to it now, having been at 1.9% for the last 7 months. And so, our target's 2. The biggest weapon we have is credibility. I think, we absolutely ought to go hit to 2. And I don't think we're talking about massive damage has to be done to hit our target, or we've created some unattainable target. That's the first point. We do on a regular basis, reassess monetary policy in our framework. We do it about every 5 years. The most recent one was in 2020. And when we look at it again, I'm sure we'll look at everything, including how we articulate our objectives. And I don't know what will change. I'm not saying anything will change or not change, but if we haven't learned something from the last 5 years, I'll be disappointed, because I think we've learned a lot. For me, what I've learned is not that 2% is unattainable. Actually, those of you who think we're about soft landing and we ought to lower rates tomorrow are basically saying it's attainable. And I just don't think throwing away your credibility. If you said, stop, I've just changed my mind, the target's 3, well, then who would believe you're actually going to hit 3?
Any other questions? I want to make sure. And we have one here.
Hi, Eric Maggio, Donahoe. With Tom, with growth, unemployment, and inflation all in a good spot and generally trending better, this question gets asked a lot. Why is the consumer not on board? Consumer sentiment is still low. Mm-hmm. I think the last poll, it was a little better, but what is it going to take to get that consumer to get this disconnect between how good the economy is doing and how bad the consumer feels?
Great question. And 5 years ago, I actually did a speech making the case that sentiment mattered a ton in terms of consumer spending and the like. But what we've seen in the last 2 years has been very different from the history, which is that consumer sentiment has been very negative, but spending has been very strong. And that's not what you normally see. And I attribute it 110% to inflation. It turns out that everybody hates inflation, and consumers really hate inflation. And so when inflation's elevated, you can say everything you want about employment or whatever, but they really don't like it, and that brings them down. And it's especially when the inflation is on items that they buy all the time, stuff in the grocery store, gasoline. You just sort of hit every day with this realization that everything's gotten more expensive, and if you will, the world has gotten more difficult. There is no mental ledger, by the way, that says my wages went up 5% and my prices went up 5% and that's fair. That's not how, Jim Davis is here, took me to a place. Thank you, Jim. We did a series with a whole bunch of construction workers, and I was trying to get them to say, your wages are up 10%, why are you so unhappy about prices being 5%? And they just don't go there. I mean, it's two different ledgers. One ledger is wages, which is finally my boss recognizes how valuable I am. And the other ledger is prices, which is somebody's screwing me. And that's how people think. And so they're unhappy about inflation. Even today, with inflation down, I think they're unhappy about relative prices. In other words, they don't just look at it on a 1 year basis like we do. They look at it on a 3 or 4 year basis. And they still remember when, my Diet Mountain Dew was half the price that it is today. That's how they think. And there's obviously some tail to it. So the last month or two, the sentiment has actually bumped up a ton. Maybe the most recent numbers are making people more optimistic. Who knows? But I think it's absolutely inflation. And it's why, we're so serious, I'm so serious about this notion of doing what we need to do on inflation, because I think we've learned the economy is not working for anybody when prices are as volatile and as high as they were 2 years ago. And I'm not saying it was good, but it's helpful to relearn that, I think, again, and do what you need to do about it.
All right, one last question.
Hi.
All right, okay.
Yeah, hi. Okay, no worries.
No, that's perfect.
Okay, well, good afternoon, everybody, and welcome, Tom.
Thanks.
Just wanted to get your perspective on U.S. global competitiveness, and in particular China, and maybe get your perspective on whether it's decoupling or de-risking.
Well, so, one thing we just ought to feel good about is the competitiveness of this economy. And it was true after 2008, and it's doubly true today. We came back faster. Our growth has been stronger, our employment has been better, and our prices have come down faster than really any of the other developed countries. I'm not talking about China, I'll get there in a second. But that's been a huge strength of ours, and it's all the stuff you know about in terms of the vibrancy of the US economy. I do think that over the last 5 years, there's been an increasing focus and understanding by businesses that the simplistic view of globalization just wasn't going to work the way it did before, whether that be supply chain outages, Fukushima, with the nuclear incident in Japan, or the tariff issues with China, or even geopolitics. And so I do talk to businesses that are diversifying their supply chain, quite significantly. You'd like to think that there was a lot of onshoring, and there's a little onshoring. I think people struggling to find workers. There's a lot more movement to Mexico or Vietnam than there is moving back to the US. But regardless, if your supply chain is entirely dependent on one country now, China or another, I think that just feels like a very dangerous supply chain choice, given what we know geopolitically and what we've seen from the supply chain side. So I definitely think people are doing that, and that is de-risking. Decoupling, that's a whole nother scenario, and there's a bunch of politics on that I'm no expert on, but you can see the risks.
All right, one last question. We have one more here.
Hi, Tom. Andy Navarrete from Capital One. Thank you for everything you're doing for the system. I'm tempted to ask a bunch of questions around bank supervision, but I'll refrain, try to keep it more general.
Thank you.
one of the, one of the elements of, or consequences of rate increases, of course, making certain things more expensive. And so as society sort of grapples with issues like affordable housing or even adoption of EVs, if you're raising rates or keeping rates at a sustained level, EVs are more expensive, housing is more expensive. Does that actually enter into the calculus at all, or the conversation at the FOMC? Or are you sort of required to be agnostic to those kinds of, broader concerns?
Well, inflation, unemployment, we're trying to think about the whole economy, inflation, underemployment. It is absolutely the case, and it's an unfortunate part of the case, that interest rate increases hit certain sectors earlier than other sectors, commercial real estate, being a classic example, housing being another example. The logic isn't to raise rates, to raise costs, to raise prices. The average is to raise rates, to lower demand, to lower costs, to lower prices. And so maybe the best way that I've come to think about it is short-term versus long-term, right? What we're trying to do is to get prices down in the long term. That might require a certain set of costs. Segments that interest costs are a big part of their costs, like banking or real estate, have to have some short-term increase in costs so that the economy broadly brings down prices and therefore costs come down. I think it's a horizon issue, solves your question. But I don't think anyone thinks if you took rates up as high as you want to, in some way you're creating more inflation. I think what you're doing is you're actually doing something to lower inflation. I hope you think we're proving that now, but that doesn't mean in every sector, in every cost structure, it works out equally.
One last one. This really is the last one, and then.
Hi, Osman Ahmed with PayPal. I'm curious if you have an explanation for the productivity numbers, the relatively unprecedented productivity numbers over the last couple of quarters. Is it entirely labor? Is it technological innovation? Is it something else? And where do you potentially see that trend going forward?
Yeah, so productivity is a tough one for those who don't follow the numbers. For the 10 years before COVID, it was about 1.4% a year, labor productivity. Then it spiked in 2020 because a bunch of service workers left the economy and their lower productivity, the way the numbers work. And so productivity increased, but it was really a mix issue. In 2021 and 2022, productivity plummeted. Same issue in reverse. They're coming back in, mix issue. And you could also say some of that was couldn't find labor, wrong person for the job, didn't have the skills. Over the last 4 quarters, productivity has been quite strong. So I honestly don't know what to make of it, because you had this trend line and then you had spike, plummet, spike. And so the way I look at it is I just look at the 4 years. I want to go over all the spikes. And where we are is the last 4 years productivity has been 1.6%. That's modestly, hint, higher than the 1.4% pre-COVID, but I don't think it's high enough for me to conclude that we've gone to some different productivity paradigm. But if we have a few more quarters that are like the last few quarters, I'll change my mind on that. I do think, I guess a couple other things on productivity. I do think when labor is short, there is a big incentive for employers to think hard about alternatives to hiring, like automation or AI or whatever. And so I think the incentive's there to invest in labor productivity. The second thing I'd point out is that if you go to a restaurant and the service isn't very good because they're running short staff, that shows up in the productivity stat, but it's not actual productivity. It's just poor service, not measured as productivity. And so you have to be a little careful during times where we have sectors that are still short staff as to where we're actually landing this. But the 1.6 versus 1.4 is how I think about it. And I'm just going to watch the next year or so and see what trajectory we're on.
And with that, Tom, thank you.
No,
Thank
great,
you for
great being
joining
back with you
us
all
today.
Thanks.